something just came out and you are not going to want to miss this. The Federal Reserve just held rates steady again, and people are reaching out asking what this means for their savings, their Social Security, their monthly income. This just came out, and it connects directly to your retirement budget right now in 2026. There are updates on interest rates, updates on what is happening with CD rates and savings accounts, and we need to talk about how the Social Security COLA fits into all of this. So stick with me right here because I am going to walk you through everything in plain language. No confusing financial jargon, nothing that is going to go over your head. This is your money and your retirement, and you deserve to know exactly what is going on. And before we go any further, if you find this kind of update helpful, go ahead and hit that subscribe button right now so you never miss one of these updates. I will keep you updated every single time something changes that affects your income. All right, let us get into this. The Federal Reserve just wrapped up its April 29th meeting, and here's the headline. They held interest rates exactly where they were. No cut, no hike. Rates stayed in the range of 3.5 to 3.75%. Now you might be thinking, okay, so nothing changed. Why does this matter to me? And that is exactly the right question to be asking. Because when the Fed holds rates steady, it sends a signal that they are not confident enough in the economy to move in either direction just yet. They are watching inflation. They are watching the job market. They are watching oil prices. And all of that uncertainty has a direct connection to the money you are living on every single month. Let me explain what this means for you if you are on Social Security, SSI, or SSDI. And I will also explain what it means if you have any money sitting in a savings account, a certificate of deposit, or a money market account, because this rate decision touches all of it. And I want you to understand every piece. So the first thing you need to know is that the Fed has now held rates steady for the third meeting of 2026 in a row. They cut rates 3 times back in the second half of 2025, but now they have stopped cutting. And based on what the markets are signaling right now, many analysts are saying there may not be another cut for the rest of this year. That is a significant shift, and it matters for every single person on a fixed income in America. Here's why this matters so much. For the past couple of years, if you had money in a high-yield savings account or a certificate of deposit, you were actually earning pretty decent interest. Some of the top CD rates were above 5% just a couple of years ago. That was one of the few silver linings for people on fixed incomes during all that inflation. But here is what has been happening. As the Fed cut rates through 2024 and 2025, those CD rates started coming down too. Banks follow the Fed. And now, according to analysts at Bankrate, the top rates on one-year CDs are projected to fall to around 3.5% annual percentage yield for 2026. That is down roughly a full percentage point from where the best rates were just a year ago. Now, here's the important thing I want you to hear. And stick with me on this. The rate pause, meaning the Fed holding steady, is actually giving you a small window of stability right now. When the Fed is not cutting, banks are not rushing to lower their deposit rates either. That means if you have money to put into a CD right now, this is one of the better times to lock something in before rates potentially fall further. Financial experts are specifically telling savers right now that a short-term CD, something in the 6-month to 1-year range, could be a smart move. You get to lock in a solid rate without being tied up for years in case things change again. Now let us talk about Social Security, because this is where a lot of you are reaching out with questions. And you are right to be paying attention to all of this together, because the interest rate environment and your Social Security payment are more connected than most people realize. Here is the situation as it stands right now in 2026. Social Security got a 2.8% cost of living adjustment starting in January. That boosted the average monthly retirement benefit by about $56. So the average monthly payment went from around $2,015 up to about $2,071. For people on SSI, the maximum federal monthly payment went from $967 up to $994 per month, which is still below $1,000 a month. And for SSDI recipients, the average monthly benefit went up about $44. Now, I want to be honest with you because that is what this channel is about. A $56 increase sounds helpful on paper, and it is better than nothing. But here is the problem that so many of you are already living. Inflation is still running hot in the areas that matter most to older Americans. We are talking about food. We are talking about housing. We are talking about healthcare. The cost of at-home elderly care jumped over 11% just last year. Medical services rose nearly 4% on top of that. So while your Social Security went up 2.8%, the things you actually spend money on are going up much faster than that. That gap is real and it is painful. And now here is another piece of this. I need to walk you through because it affects millions of people. And it quietly ate into that 2.8% COLA before you even saw it. Medicare Part B premiums went up significantly in 2026. The standard premium jumped to around $202.90 per month. That is up from about $185 last year. So, for people enrolled in Medicare who have that premium deducted directly from their Social Security check, that Medicare increase alone wiped out a good portion of that $56 COLA gain. You can see why so many of you are writing and saying the numbers just do not add up. And I want you to know that frustration is completely valid. The ARP actually ran a poll asking seniors what they would actually need in a COLA to feel like they were keeping up. The answer was around 5%, and we got 2.8. So there is a real and documented gap between what the adjustment provides and what actual life costs for older Americans right now. Now, here is where I want to give you something real to hold on to, because I am not just here to tell you what is going wrong. I want to help you understand what you can actually do about it. The first thing is about your savings. If you have any money sitting in a basic savings account at a big bank, you are probably earning almost nothing on it. The national average savings rate is hovering around 1.5% to 2% right now. But there are online banks and credit unions offering high-yield savings accounts with rates around 4% right now. That is a massive difference. If you have any amount of money set aside, even $10,000 at 4% earns you $400 in interest over a year. At the national average rate, that same $10,000 earns you maybe $20. So please, if you have not looked at where your savings are sitting, now is the time. The second thing is about CDs. As I mentioned, rates are still decent right now. Analysts at Bankrate and NerdWallet are both saying that the window to lock in a good rate is narrowing, especially if the Fed does start cutting again later this year, or if a new Fed chair takes a more aggressive approach to rate cuts. Experts are pointing to short-term CDs as a smart middle ground right now. You lock in a good rate, you keep some flexibility, and you do not tie yourself up for 5 years in case rates actually move in your favor down the road. I will keep you updated on all of that as we get closer to the Fed's next meeting. The next scheduled Federal Open Market Committee meeting is June 16th and 17th of 2026. That meeting will include updated projections on growth, inflation, and where rates are headed. And that is going to tell us a lot about what the second half of 2026 looks like for your income. Now, I also want to mention something that affects our neighbors in Canada, because a lot of you have family there or split your time between both countries. Canada's central bank has also been navigating a rate environment very similar to what we are seeing here. Their rates have been coming down, and the impact on Canadian retirees, especially those on fixed pensions or government benefit programs, is tracking very closely to what American retirees are experiencing. The inflation squeeze, the rising healthcare costs, the gap between what benefits provide and what life costs, it is a shared struggle on both sides of the border right now. And I will keep covering both as things develop, because you deserve the full picture. Let me bring this back home for a moment and recap what we covered today, because I want to make sure this is crystal clear before you go. The Federal Reserve held interest rates steady at their April 29th meeting. The target rate range is 3.5 to 3.75%, and it is not expected to change for the rest of 2026. That means savings and CD rates are going to stay relatively stable for now, but they are going to drift lower over time as competition between banks adjusts. Social Security's 2.8% COLA in 2026 added an average of $56 a month. But for Medicare enrollees, rising Part B premiums ate into a significant portion of that increase, and inflation in healthcare, housing, and food continues to outpace the COLA for most seniors. The advice right now is to look at where your money is sitting, explore high-yield savings accounts if you have not already, and seriously consider a short-term CD to lock in a decent rate before things shift further. None of this is panic-worthy, but all of it is worth paying close attention to. And as always, I will be right here watching every development for you. The next Fed meeting is June 16th and 17th, and I will have a full update ready for you the moment we get that decision and what it means for your retirement income. If this video helped you today, please share it with someone you care about. A parent, a neighbor, a friend who is trying to make sense of all of this, because this information belongs to everyone on a fixed income, not just the people who go looking for it. I am going to keep showing up for you every single day with these updates. You are not alone in this, and as long as things are changing, I will keep you informed. Take care of yourself, and I will see you in the next one.